What if I told you that the majority of people who enter the stock market don't just fail to beat it, they actually lose money? Sounds surprising, right? After all, you always hear stories of people making huge gains. But here's the truth. For every winner, there are many more silent losers. And today, we're going to break down exactly why that happens and how you can avoid becoming one of them. The stock market isn't rigged against you. It's just that most people enter it with the wrong mindset, wrong strategy, and unrealistic expectations. In this video, we'll go deep into the biggest reasons why people lose money in stocks backed by real-world behavior and simple ways you can stay ahead. Let's start with the biggest culprit, emotions. Humans are not wired to be good investors. When a market is going up, excitement and greed kick in. You see others making money. Social media is full of success stories, and suddenly you feel like you're missing out. So what do most people do? They buy at high prices. Now flip the situation. The market drops. News channels talk about crashes. Your portfolio is in red. Fear takes over. And what happens? People panic and sell at a loss. This creates a destructive cycle. Buy high, sell low, repeat. Successful investors do the opposite. They stay calm, think rationally, and often buy when others are fearful. Another major reason people lose money is simple. They don't understand what they're investing in. They buy stocks based on tips from friends, social media hype, hot picks, or trending companies. But ask them one question. How does this company actually make money? And most won't have a clear answer. Investing without understanding is no different from gambling. Real investors study the company's business model, revenue and profit growth, industry trends, competitive advantage. Without this knowledge, you're just guessing, and guessing is expensive. Many people treat the stock market like a quick cash machine. They expect to double their money in weeks or months. And when that doesn't happen, frustration sets in. This leads to two dangerous behaviors. 1. Selling too early. 2. Taking bigger risks to make up for lost time. But historically, the stock market rewards time, not timing. Long-term investors who stay consistent and patient often outperform those who constantly jump in and out. Doing more doesn't mean earning more. Many beginners believe that frequent trading equals higher profits. But in reality, overtrading leads to higher transaction costs, poor decision-making, increased emotional stress. Even professional traders struggle to consistently time the market. For most people, a simple strategy, investing regularly and holding for the long term, often works better than constant buying and selling. This is where many people make their biggest mistakes. They put all their money into one stock, one sector, or one big opportunity. It might work temporarily, but when that investment fails, everything crashes with it. Smart investors manage risk by diversifying across multiple stocks or sectors, not investing money they can't afford to lose, having a clear plan before investing. The goal isn't just to make money, it's to protect it. There's a strong temptation to follow what everyone else is doing. If everyone is talking about a stock, it feels safe to invest in it. But by the time something becomes popular, it's often already overpriced. The crowd usually reacts late, buying at peaks and selling during crashes. Independent thinking is what separates successful investors from the majority. Most people enter the market without a clear plan. They don't define when to buy, when to sell, how much to invest, what their long-term goal is. So they end up reacting to every market movement. Successful investing isn't about reacting. It's about following a strategy consistently, even when emotions try to take over. So why do most people lose money in stocks? Because they let emotions control decisions. Invest without knowledge. Chase quick profits. Trade too often. Ignore risk. Follow the crowd. And lack discipline. But here's the powerful part. None of these are unavoidable. If you can control your mindset, stay patient, keep learning, and stick to a strategy, you can already do better than most investors. If you found this video valuable, hit the like button and subscribe for more content on investing and financial growth.